All right. Good morning, everybody. Good morning, all you magnificent melon heads of the world. I hope you guys are well. Today is Wednesday, April 3rd, 2024. The top story this morning is once again the Strategic Petroleum Reserve. There's something we haven't heard in a while. You guys remember the SPR, right? We dumped 180 million barrels of oil back in 2022 after the Russians invaded the Ukraine, and we had a midterm election going on, and we got to get those oil prices down for midterms, right? Well, it's an election year again, and once again, the price of oil might be playing a role here. The announcement just hit the tape not too long ago, just a few hours ago. My moderator, Mish, caught it this morning. Mish, good catch. The U.S. government has canceled plans to order 3 million barrels of oil to replenish that which was dumped back in 2022. The reason given was high oil prices. The government wants to buy that oil back at $79 per barrel or lower. Well, oil prices aren't really cooperating right now. Oil's back above $85 for West Texas Intermediate. And so the government canceled their plans. And, well, at the current rate of refilling the SPR, based on my calculations, carry the one, it should be freaking never when we get back up to 600 million barrels in the Strategic Petroleum Reserve at the rate they're refilling it. Freaking never, because at this pace, they did buy about 2.8 million barrels last month. They have refilled it a tiny little bit, but at the current rate, the next crisis forcing them to dump from the SPR will be here before we get anywhere near the level we were at before the Russians invaded Ukraine. And so, the government kind of has their head up their wazoo here, guys. Oil, you got to buy it back where you can. And there may be a time not too long from now where we wish we had bought that oil at $85 a barrel instead of holding out for $79. Now, oil prices have been down pretty much in the doldrums most of this year. We haven't talked a lot about oil prices. We visited every day during our trip through commodities, but they have been creeping up over the last month or so. And this announcement today, this may end up being a major geopolitical blunder here, because right now, as we speak, the OPEC plus meeting of the Joint Ministerial Marketing Committee, I think is what they call it, the JMMC, basically the big OPEC meeting just started. And, well, you may know OPEC freaking hates us. And, whether that's justified or not, feel free to have that one out in the comments. But they're not our best friends on the block, all right? I don't think that's a controversial statement, to say the least. And the OPEC has been pretty irritated, especially Saudi Arabia, who claims to be our friends. They've been a little irritated with the United States. First of all, the SPR dumping really hurt their bottom line. And then the fact that we're taking our sweet time refilling it is also upsetting the Saudis, because that is also suppressing oil prices. So we've got this announcement today, right as the OPEC people are getting together to decide if they are going to cut production again or raise production again or decide what they're going to do with supply. And so, maybe poking that bear right now, not the best idea. Maybe you want to wait a few days for that announcement, or maybe better yet, you just pay $85 a barrel to refill the SPR, because, oh, by the way, World War III, that whole thing might be happening here soon. And we'll probably wish we had that oil in storage if and when that happens. I hope it doesn't, but it seems like we're on autopilot. So this may end up being yet another strategic blunder when it comes to oil and geopolitics and the Strategic Petroleum Reserve here. So that's a big one going on this morning. We'll see if oil prices weren't really reacting to it right away, but I think in the grand scheme of things, this is putting artificial downward pressure on oil prices. The fact that we're taking our sweet time refilling the SPR here, if we were refilling it at anything resembling a reasonable pace, oil would probably be well over $90 a barrel at this point. Also going on this morning, or should I say early yesterday, the story broke. Tesla missed their vehicle deliveries big time. Tesla actually had a decline of 8.5% in vehicle deliveries in the last quarter. That is the first decline in Tesla's production since the height of the pandemic in 2020. Now, there was a couple of reasons given. They're making some changes to their plant in California. And of course, you had that, greeny hipster terrorist, whatever you want to call it, arson attack on the power grid in, I believe it was their German plant that shut down production at their German plant for several days. So that affected Tesla's bottom line. But or it affected their production capacity. But at the same time, while those stories were factual and we do have that decline in production being partially driven by that, you've also got increases in inventory of electric vehicles happening at dealerships all across the country. So Tesla's kind of pointing to that arson attack, and they're pointing to the changes at the California factory and saying, this is why we missed our deliveries and why deliveries are down. But really, it's because EV sales are down. And it's not just EV sales that are down. All vehicle sales are down. We've got inventory is growing at most of America's auto dealerships. They ticked down just a little bit in March, but for the several months leading up to that, they were growing rapidly. Total vehicle sales data just came out this morning. They're down again. The auto market is in trouble here. Sales are declining. Why? Because people can't afford cars. It's that simple. Between the ridiculous sticker price of a new car and the ridiculous interest rates people are paying to finance their cars, with the average car payment well over $700, and a lot of people carrying $1,000 a month car payments. Good God. People just can't afford cars. You know, there was this video I keep seeing pop up in my feed, this shorts, where this person's walking around a car dealership saying, what do you drive and what's your payment? And there's this girl sitting at the desk says, oh, I drive a 2023, this or that, and my payment is $1,300 a month. And I remember saying, what? $1,300 a month for a car payment for an administrative assistant at an auto dealership? Somebody who's probably bringing home, I don't know, what, $55,000 a year? $1,300 a month in an auto payment? Wow, ridiculous. So the car industry's in big trouble. Pay attention there, guys, because we're trending down, and we're still nowhere near GFC levels, but hey, unemployment still pretty good. I know unemployment numbers are rising. I know the jobs numbers, the data is very suspect, but right now the employment situation is at least okay. We've lost full-time jobs, we've gained part-time jobs, and people are driving Ubers to try to compensate and things like that. But right now the jobs market is somewhat cooperative. Well, what happens to auto sales if the jobs market starts not being cooperative? Something to think about. And speaking about the jobs market, we got some data over the last 2 days. If you were looking for clues about what we might see on Friday with the non-farm payrolls report that's coming out, the big jobs report comes out on Friday, we didn't really get much of a clue with this data. We got JOLTS and the job quits results yesterday. Didn't really tell us much, to be honest with you. And then just this morning, we got ADP private payrolls. They looked pretty good, showing a little bit of growth. So maybe the JOLTS and the ADP data is showing a little bit of strength in the labor market. So maybe I'm leaning towards a slightly better jobs report on Friday. But then again, we've got all this anecdata of layoffs all over the place and white-collar jobs. So it's really hard to try to guesstimate what we might see on Friday. So we're just going to wait for that jobs report to come out on Friday. We've got Intel just reported $7 billion in losses from their chip foundry business. That's the first time they've ever actually reported the specifics of their foundry operations to see how much money they're making. Intel's kind of an oddity in the semiconductor space. They design and make their own chips, unlike, say, an NVIDIA, who they design their chips, but then they hire Taiwan Semi to manufacture them. Well, Intel does the whole thing in-house, and they're losing a ton of money doing that. That's important, guys, because we want to build this domestic chip production capacity here in the United States. We're subsidizing the hell out of the semiconductor industry because, well, we need the chips industry. Now they're saying, oh, it's about American jobs and the American economy. It's not. It's about missiles and things that go boom, because we get all of the chips that go in the guidance systems of our fancy Tomahawks and SM2s, SM6s and JASMs and LRASMs and all this magnificent ordnance that kills people. There's a lot of chips in that stuff, and it's all made in Taiwan Semiconductor's factory, which will probably be the biggest target on day one if the Chinese ever decide to invade Taiwan. So we need those chips factories here to be able to maintain our ammunition stockpiles. So that's really why we're building these big chips plants. Yeah, they're saying it's about the economy and jobs. It's not. It's about war. And speaking of Taiwan Semiconductor, there was a big earthquake in Taiwan yesterday, the biggest earthquake in 25 years. It looks like Taiwan Semiconductor has shut down some of their fabrication operations as a precaution. No word yet on any damage to Taiwan Semi's industries or their capacity there. Also, casualty reports coming in. It looks like a few people have been killed in that earthquake. We don't know how bad yet. but initial estimates, not that bad, even though it was the strongest quake in 25 years. But that could cause some economic problems if there was damage to the Taiwan semi-fab plants. Then we could potentially see disruptions. And, hey, NVIDIA, their magnificent GPUs, they're all made by Taiwan Semiconductor. So if that factory doesn't spin back up soon, it could start to affect the AI mania stocks. A lot going on today, guys. Why don't we shrink my big melon of a head and let's see what's happening in the market, digesting all of this news this morning. Guys, don't forget the like button while we're doing this. It really helps with the YouTube algorithm. And if you're a first-timer here, hit that subscribe button and notification bell because we do this every morning. So have your coffee with the melon heads as we go through markets. The S&P 500 is down again this morning, 9.5 points or 0.18% to the downside. We've got the Dow is also down 30 points or 0.08% this morning. And the NASDAQ is down 68 points, 0.38% lower for the NASDAQ. So 3 consecutive mornings here with some red ink on the charts here. Market's still digesting all that inflationary impulses that we got from some of the data in the ISM and the S&P PMIs, also the PCE data we got on Friday, all showing. Some people are saying it's showing strength in the economy. Others are saying it's showing that inflation is being stubborn and it's not going away. Whatever your interpretation of the data, it means a more aggressive Federal Reserve, and the market is starting to adjust for that. We've got the U.S. dollar right now. For whatever reason, my chart is not loading, but the U.S. dollar is modestly higher this morning, modestly lower this morning, down 12 basis points at 104.71. So the dollar's a little bit weaker here. And looking at the bond market, we've got yields are up again. Wow, 3 consecutive days of higher yields. 30-year Treasury yielding 4.545. That's up 3.5 basis points. The 10-year is at 4.412, up 4.5 points again this morning. What's that, about 30 points in 3 days? We've seen the 10-year rise. Big, sharp increases in interest rates here, guys. You bet that's going to start hitting the housing data soon. It's probably going to make that auto data worse also. The 2-year Treasury, 4.731. That is up another 3 basis points. And the 1 month is at 5.386. It's showing up 1 point again, but pretty much where it was yesterday on the 1 month. Looking at the commodities board, gold's rally continues. Look at that high, intraday high there, $2,308 for June gold futures. Now we're just off that level here at $22.95 and 30 cents as of the making of this video. That's up $13.65. 0.6% higher. Gold's still marching higher, making new highs on a daily basis. Congratulations, stackers. You guys have been bludgeoned since the height of the silver squeeze in 2021. You've watched this manipulation. You've watched Mr. Slammy do his thing at the London fix. Stackers finally being rewarded for their patience here. Gold is telling us inflation is coming back. I've been talking about that for the last few days here. And even silver is getting in on it again this morning. Silver rose more than $1 yesterday. May silver futures this morning at $26.73, up another 80 cents or 3.1% higher this morning. I mentioned this a few days ago. Hey, silver has been sitting out this rally. Guys, silver might be a good trade here. It's got a lot of catching up to do to get in line with this move that gold has made. And, well, there it goes. Now, the reason I suspected, and I talked about this in my interview with Mario Ineco and Jesse Day yesterday over at the Vancouver Resource Investment Conference channel, said, hey, silver was sitting it out. It wasn't really participating in this gold rally because the industrial data has been so bad, and silver is predominantly an industrial metal, or about 50-50 industrial/monetary. Well, we got some good industrial data over the last few days, and now all of a sudden silver's rallying like the blazes. It's catching up really fast. So, guys, gold making new all-time highs at $2,300. For silver to make a new all-time high, we're talking $50 here. So if this rally in precious metals is for real, and I suspect it is, that means there is a lot of upside for silver here. And I mean a lot of upside for silver here. So keep an eye on that one. Also, platinum up about 0.6%. Palladium is up 0.5%. So all the metals are getting in on it today. Even copper is up here almost 2% at $4.15 for May copper futures. And, of course, let's talk about oil. All the commodities are doing well. Oil's doing great here, $85.69, up another 50 cents or 0.63% higher for May WTI futures. Well, let's talk about this one here. Well, before we go through that, let's do Bitcoin real fast. Bitcoin, 65,881 this morning. That's up about $400. Bitcoin got bludgeoned yesterday. Big red candle, lost about $5,000 in price. Now, the interesting thing about that big decline in Bitcoin yesterday is it was not being driven by ETFs. And that's the first time we've seen a big candle in a Bitcoin chart that wasn't caused by the ETFs, the first time in a few months. Now, here's the ETF flows. Shout out to Zero Hedge who puts this chart together. You can see we had net inflows yesterday. The yellow and the above is bigger than the black and the red here. So we had net inflows of $40 million into the Bitcoin ETFs yesterday. So all of that selling pressure, it was not coming from the ETFs. Now, there was one interesting thing. We got a big red square down here. That is the ARK 21 shares Bitcoin ETF. That's the first time we've seen any big outflows from that particular ETF. We've actually seen a lot of net inflows into that one. So that kind of stuck out at me as a little odd yesterday, but it doesn't explain the big move. I did see some rumors floating around on Twitter that a lot of old Bitcoin that was either from Mt. Gox or from Silk Road, basically this old Bitcoin that the government had been sitting on for years because it was seized, had been moved to a Coinbase wallet, which could mean that the government is getting ready to dump some of their Bitcoin. I haven't been able to confirm that story, but I saw that all over the place on Twitter yesterday. And if that's the case, it's possible you had a couple of big players, maybe some whales were selling ahead of that news, trying to get out in front of it. Or you could just have people trying to manipulate the market lower, trying to engineer a sell-off so they could buy it up. Either way, sharp sell-off in Bitcoin yesterday, although it's still sitting pretty close to all-time highs here. All right, now let's get back onto the oil story here. U.S. cancels latest oil reserve refill plan amid high prices. They are taking their sweet time. The Biden administration won't move forward with its latest plans to buy oil for the Strategic Petroleum Reserve amid rising prices. The Energy Department said it was keeping the taxpayers' interests at the forefront. Well, nice of you guys to start worrying about the taxpayers for a change. Let's not talk about the trillions of dollars you dumped into EVs and chips and God knows what. Oh, yeah, great stewards of the taxpayers' money. The government is. Keep up the good work, guys. That was in their decision not to purchase as many as 3 million barrels of oil for the Strategic Petroleum Reserve site in Louisiana. The plan for the barrels to be delivered in August and September had been announced in mid-March. We will not award the current solicitations for the Bayou Choctaw SPR site and will solicit available capacity as market conditions allow, the department said. We will continue to monitor market dynamics, and I just feel great knowing that they are monitoring those market dynamics. Doesn't that make you feel reassured and safe and all warm and fuzzy inside, knowing that these partisan hacks are monitoring market dynamics? You guys, keep up the good work. That's really, really top-notch stuff there. The move follows a rally in crude prices, with U.S. benchmark West Texas Intermediate on Tuesday breaking above $85 a barrel for the first time since October. The Biden administration has a target to buy oil at $79 or lower to refill the reserve, though spent an average of about $81 a barrel at its latest purchase of $2.8 million barrels late last month. So let's look at the oil chart here, guys. These are daily candles on the oil chart going all the way back to May of 2022. All right, so here was the whole big panic after the Russian invasion of Ukraine. And then, they announced, hey, we're going to dump 180 million barrels of oil from the SPR. Of course, that crashed oil prices. Prices went way down for most of 22 into the beginning of 23 as we were just artificially inflating the supply of oil by dumping our emergency stockpile. Now, this red line I showed here, horizontal, that's at $79. That is the price below which the government plans to buy their oil, above which they're saying they're not going to buy it. And you can see they have made a few buys, a few million here and there, but this chart has spent a good amount of time below $79 a barrel, and the government has not bought that oil. Now, the reason why is if they buy that oil below $79 a barrel, it won't be below $79 a barrel because buying millions of barrels of oil drives the price higher. And so this red line, it's pointless. I drew it here, but you can see, yeah, the chart spent some time here. But as soon as they announce we're buying a few million barrels, the price just rockets right back up. You're not going to get much oil below $79 a barrel here. And of course, now prices are moving higher. And guys, pay attention, because while this has been going on, remember all these big declines in inflation? Well, look, oil was primarily driving that. Energy has been so much lower for the better part of the last year. Well, now we've got core inflation, which strips out food and energy. Core inflation is stubbornly high. And you can see here, since pretty much the middle of December, now the energy inflation is starting to come back. So we've got higher CPI prints coming from this data, guys. And take a look at this one also. This is the actual stockpiles in the Strategic Petroleum Reserve. This is the Energy Information Administration puts this out. These are weekly snapshots. And you can see here the pre-Russian invasion. You know, we had started selling a little bit of the SPR oil. That started under Trump, these regular quarterly sales. So we had already been bringing down the SPR a little bit. And then the Russians invaded, and we went from about 600 million barrels of oil to all the way down to about 346 million barrels. And now you see, if you squint, you can just see it. If you look real closely, you see this little bitty uptick there? You see that there? That little bitty uptick from about 346 million barrels to about 363. That is all of the replenishment of the Strategic Petroleum Reserve that we've done in the last about year and a half since we stopped dumping that oil. So at this pace, how long do you think it's going to be before we get back up to 600 million barrels? Besides freaking never, because well before we get back up to 600 million barrels, there's going to be some hurricane or some fire at some plant or some dictator that does a thing, driving oil prices higher, and they go back to dumping the SPR. This is the ultimate case study of politicians screwing the people who come after them in order for short-term political gain. It's one of the biggest problems with the way our businesses operate. It's one of the biggest problems with the way our government operates. We're all about that next quarterly report, that next election, that next midterm. What happens 10 years from now, who cares? Let's just worry about our short-term goals and let the next guy deal with the problem. This is going to be another case like that. So the SPR, yeah, it is trending back up, but it is at a pathetic pace. Also going on today, Tesla quarterly deliveries declined for the first time in nearly 4 years. This was a big one. Tesla stock got clobbered yesterday off of this news. Tesla on Tuesday posted a decline in quarterly deliveries for the first time in nearly 4 years and missed Wall Street estimates, a performance some described as ugly as price cuts failed to stir demand in a highly competitive market. That's right, guys. The prices of these things are going down too. Prices are going down. Production is going down. Inventory is going up. Are you noticing the pattern here in the vehicle market? Shares of the Elon Musk-led company were down 5.2% at $166 on Tuesday afternoon, losing about $30 billion in market value. The shares have fallen about 33% so far this year, and that's why Tesla has been excommunicated from the Magnificent Seven, which is now the Magnificent Six. Really the Magnificent Five, because Apple is right behind them. Apple has had a lot of downgrades, not doing that good this year. So it's only 5 companies that are holding the stock market at all-time highs here. After years of rapid sales growth that helped turn Tesla into the world's most valuable automaker, the company is bracing for a slowdown in 2024. The EV maker has been slow to refresh its aging models as high interest rates have sapped consumer appetite for big-ticket items, and rivals in China, the world's largest automaker, world's largest auto market, are rolling out cheaper models. Tesla's deliveries declined by 8.5% in the first quarter to 386,810 vehicles from a year ago, and the company produced 433,371 vehicles during that period. Wall Street had expected Tesla to deliver 454,200 vehicles, according to the average projection of 18 analysts. So big miss on vehicle production. The last time the automaker posted a sales fall was in the second quarter of 2020, when the COVID-19 pandemic forced Tesla to shut down production. So this was this is a big deal here. The last time they had a decline was at the height of the bat flu panic. Tesla attributed the drop in volumes partly to efforts to prepare its Fremont, California factory to handle increased production of the updated Model 3, and also to shutdowns at its Berlin plant due to the impacts of the Red Sea conflict and an arson attack. But Tesla produced 46,000 more vehicles than it sold in the first quarter, signaling softer demand, analysts said. That's a big one right there, guys, that talking point. Even though they missed, even though they had that 8.5% decline in production, they still produced more than they sold. So inventory is rising. The vehicle inventory confirms that beyond the known production bottleneck, there may also be a serious demand issue. That's according to Deutsche Bank analyst Emmanuel Rosner. And let's talk about those demand issues, because we got total vehicle sales this morning from the National Automobile Dealers Association. Total vehicle sales in the United States decreased to 15.5 million in March from 15.8 million in February of 2024. That is down 300,000 cars. This is an annualized rate, so it's a moving target, but a decline of 300,000 annualized in vehicle sales. Now, let's look at this chart here, guys. This is about 5 years, going back to the middle of 2019. This is showing the annualized rate of auto sales in the United States. Now, pre-pandemic, the United States was selling about 17 million cars a year. And then obviously the pandemic made a mess out of the car market. They declined, and then they spiked back up when the stimmy cash started flowing. And then they bottomed out again when the stimmy cash stopped flowing and we had the chip shortage and car prices ballooned higher. Now, auto sales have been very slowly recovering since the end of 2021 as the chips crisis abated and as, interest rates started to rise and the industry started to normalize somewhat. And I use that term normal very loosely. But you can see here that right around July of last year, they peaked. And vehicle sales have stopped rising, and they peaked around 16 million sales annualized, well below the 17 million pre-pandemic average. Now it looks like this chart is starting to roll over and decline again, making lower highs and lower lows. So the auto industry never recovered from the pandemic. That's the takeaway here, guys. The cars got too expensive. The interest rates got too high. People can't afford cars, and so fewer cars are selling. It is only a matter of time before that starts to hit the jobs market. There's just too many people working in the auto industry. That's going to be a big problem. Now, also, we got jobs data in the last couple of days here. The ADP employment change came out just this morning. Private businesses in the U.S. hired 184,000 workers in March. That's following an upwardly revised 155,000 in February and beating forecasts for 148,000. It's the biggest increase in hiring in 8 months, with employment rising in services by 142,000, namely leisure and hospitality saw 63,000 jobs. Those are low-paying part-time jobs. Trade, transport, and utility saw gains of 29,000. And the goods-producing sector, mostly construction, saw an increase of 33,000. Now, this is ADP, guys. This is private payroll data. This is not a government statistic. And ADP is known to differ wildly from the government jobs numbers, so take this data with a grain of salt. But it does show for the last few months a slight uptick in employment here. The trend is your friend, as they say. It looks like a little bit of strength in the jobs market here. I don't know if that's going to show up in the private payrolls number on Friday, but ADP is showing modest growth in the jobs market. Now let's talk about JOLTS that came out yesterday. Job Openings and Labor Turnover Survey is what JOLTS stands for. The number of job openings went up by 8,000 from the previous month to 8.756 million in February, above market expectations for 8.75 million. So job openings rose last month. However, there's an important nitpick I want to make here showing this chart. Here's that little bitty increase. Now, the reason we got that increase in job openings in February is because they revised down the job openings data from January. And the only reason the number went up, if we had left the January number alone, we would have seen another decline. So this growth in job openings of only 8,000, which is just noise in the chart, the only reason it's even growth at all is because they downwardly revised last month's number to make it look like growth. So the JOLTS data doesn't really tell us much of anything. It's not strength in the jobs market. It's not weakness in the jobs market. It's just a nothing burger data point. We also got jobs quits data yesterday. The number of job quits in the United States, or people leaving their job voluntarily, rose by 38,000 from the previous month to 3.484 million in February. That's up from January's, again, revised figure of 3.446 million and touching the highest in 3 months. So we've got more people quitting their jobs. Again, you've got a chart that has been falling sharply. That's weakness in the jobs market. If people aren't quitting because they know they'll have a hard time getting a new job. But you'll notice for the last 3 months, ever so slight upticks. So even job quits is showing maybe just a little bit of strength in the jobs market here. I don't know how reliable, take this with a grain of salt. It's not the most reliable data in the world. It is a government statistic. But again, the trend is up here. So if you take these 3 data points in aggregate, the ADP private payrolls data showing a little bit of growth, the JOLTS number showing a couple of new openings, but not really, because it was really just a revision. And then the quits numbers ticking up a little bit. I'd say on net, we're seeing a little bit of strength in the jobs market here. And I want to emphasize a little bit, a very small amount of strength. I don't know I can't make any conclusions about what we're going to see on Friday based on this data. That's the one thing I want to take away from this is basically these data points did not help at all. And I just want to say thank you very much to Mr. Sharif Morsi. Thank you, Sharif Morsi, new channel member. I appreciate the support of the channel and welcome very much, sir. And also thank you to all my other magnanimous melonheads and channel members. I appreciate that, guys. And thank you, Mighty Mike, who says reverse repo down to 448. Awesome point, Mike. And I am remiss because I didn't mention that. Let me bring that chart up real quick. Reverse repo did fall. Well, it fell to 444 billion a few days ago. We got to zoom way in to get this data. All right, so we talked about this last week. That big spike in the reverse repo, guys, that was expected because it was the end of the quarter. We saw the same thing here at the end of December. And I was saying I expect this number to fall, and it did. It fell down to 441 billion yesterday. That's up to 448 billion today. Noise in the chart. So reverse repo is pretty much right back where it was before we got that spike. Thank you for pointing that out, Mike. I appreciate that one. The reverse repo, the fall in the reverse repo, the decline, it's still leveled off. We still haven't seen that drawdown that we've been seeing because the government is issuing less new treasury supply. For the last 2 quarterly refunding announcements in a row, Yellen has been borrowing less money than the market has expected. That doesn't mean the government has spent less money. It just means Yellen has been borrowing less. They've been spending money that they've already borrowed. And plus, we've got tax receipts right now. It's tax season, so there's more money coming in. So I suspect within the next quarter or so, we're going to start to see those quarterly refunding announcements are going to start to increase. That's going to sap liquidity from the bond market. And when that resumes, I think we're going to see the reverse repo start to head lower again. Thank you, Mike. I appreciate that super chat, sir, and the support of the channel. And thank you, everybody else, for having your coffee with the Melonheads this morning. I appreciate that very much. Thank you to my Patreon supporters and magnanimous Melonhead members. I appreciate that very much, guys. Looking forward to talking to you at 5 p.m. Eastern time tonight for our weekly get-together on Zoom. I got links down below to all that good stuff, should you feel so inclined. Hi, Mom. Hi, Dad. I love you guys. Everybody, till next time, live small and dream big.